I will let you.
Looks like it's
lead. Yeah, go for it.
Yeah.
Thank you to everyone who's been joining us online. Thank you to those who are able to join today. This has been an ongoing, I don't want to say saga, that makes it a little too dramatic, but just quite a process to try to figure out if there's anything that NQE can do to help our members feel more comfortable and happy and like they're getting better prices and better coverage with insurance. So today is another step on that journey. We're joined by two great, hopefully potential partners, but the point of today's session is for you to ask as many questions as possible, really kick the tires on this, and we'll see, you know, if this really turns out to be a good option for us to move in the future. So thank you as always for taking some time out of your schedule to join NQE for an event, and we will let our presenters take it away. Rob, do you have any like technical things that we should share with people?
If you want to hook up Wi-Fi is right there on the board. Feel free to grab any more food or fruit or juice. And I think that's about it. I think we're ready to go.
Fantastic.
Perfect. And we will be recording the session, so we'll make sure we get it out to those folks who want to join or want to go over the information afterwards.
Great. Are they able to speak back to me if I ask them to get online?
Yes, they should.
I'm just curious.
If they have any questions online, let me set it up.
Yep.
So, and those that are joining us virtually, if you do have any questions, just utilize the chat function. Here, I will type a message and just respond to or just ask a question at any point. And
Great.
We should be able to reach out.
Perfect. Thank you. Let's see here. So I appreciate the opportunity to come today. I know I've seen faces, so I've got familiar faces here. And those of you online, my name is Chad Miller. I am a Butler grad, Indianapolis native now 12 years. Spent 6 years at Indianapolis Metropolitan High School. 2 is a career teacher. We did TAP. I don't know if any schools are still doing TAP in the. Okay, I didn't know the cell relationship ended, and I didn't know if people would keep doing that. We were at TAP school. Currently on the board of Circle City Prep, which is going to be far east side school. Actually going to co-locate with Lighthouse for at least the first couple of years. And then kind of the insurance part of this, the last year that I spent in schools was 14-15. And then our family has owned an independent insurance agency since 1937. So I'm generation 4. My father is still very much active in the agency. We have locations in Indy here, so I'm here in Indy, and then Culver and Bremen, which are both in Marshall County, which is about 2 hours north on US 31. So we're an agency of about 20 strong, and then to kind of kick it into the partnership and where Keystone comes into this, Keystone Insurance Group is a partnership of independent agencies. So in 2006, we bought into Keystone Insurance Group, as many other independent agencies in Indiana. And it's mostly on the East Coast, moving more to the Midwest. What that allows us to do, we have $3 billion of combined premium, so it gives us leverage with carriers. It also gives me access as mainly a property and casualty agent to somebody that is a benefits expert. So that's kind of how the relationship with Keystone works. And Klaus can kind of explain that a little bit too. But that's what we're here to do. Excited about it. I hope this is, as I was sitting at a conference, and was this conference in November? Was that the Gulf State sponsored conference? Oh my gosh, it was in September. So I went there on behalf of Circle City Prep with Megan Murphy, our school leader, and I heard them talking about this. And then I heard one of the speakers say, you know, the Charter School Association disbanded, and all of a sudden I hear someone in the back pipe up and say, no, it didn't. It did, but we're trying to take this over. And I was very lucky being a part of Goodwill that I had a lot of back-end support, and I never really realized how hard it was to run a school and think about all the extra stuff, whether that's, you know, property and casualty insurance, health insurance, vendor relationships. I never had to deal with that. And I like what it looks like NQE is doing, is trying to be kind of the back office that I had at Goodwill as a Met principal, and take away some of the things and make it easier for you guys to just do what you're really good at and run a school, teach, and make kids make progress. So we're hopeful that this can be another part of that kind of puzzle to make your job easier and hopefully take some of the work off of you. So I'll kick it over to Klaus, who drove 2 hours and 45 minutes from Mishawaka, Indiana today. to join us. So thanks for doing that class.
Good morning.
Good morning.
How's everybody doing today?
Yeah.
Good. So as Chad mentioned, I'm Klaus Knuth. I'm with Keystone. I've been with Keystone since 2009, but been with the same people since 2003. And I'll be the lead benefits consultant. So if you decide that you want to pursue this, or if you have any further questions about benefits in general, state of healthcare reform, feel free to reach out to me. We can answer your questions. And as we go through this presentation today, I'd prefer if this was not a monologue. So as we're talking and you have questions, feel free to type up or chat on the chat box. And Chad, if you can monitor that, as the questions come through, and
Sure.
That way, yeah. So we have a really good team in our office, and I put Joni DeSouza's name on there. Joni manages our account executives. In our office, an account executive would be the first line of defense, if you will, for all of our client relationships. So whether it's a billing question, whether it's a claim that was not processed properly by the insurance company, someone needs a new ID card, renewal. So how are we going to handle the upcoming rate increase from the insurance company? I say rate increase because I've seen rate decreases, but those have been something that we've negotiated on behalf of our clients. So we have a very good process of managing that. And she is the one that works with our staff of 6 or 7 account executives to make sure that those client retention strategies go off without a hitch.
You want to mention anything else about that?
So Keystone, as Chad mentioned, Keystone is in 11 states. We started out in 1983 in Pennsylvania, and we have grown from 4 pioneer agencies into 270-ish. Keep adding. We just added another one yesterday in Illinois, just outside Chicago. But like Chad mentioned, over $3 billion in collective property casualty premiums that are combined. And then we have a robust benefits division. We have a robust risk management division. And one of the benefits of Keystone is that because of our economies of scale, we are able to provide a lot of services that we wouldn't be able to offer if we weren't the size of the agency that we are. But yet, Chad and his father and a couple other partners, they independently own their agency, Miller Insurance Group, and as such, they own a part of Keystone as well. So I work for this guy. So
You better do all, I'm going to fire you today.
All right, we head back here, the agenda. So you can see we have 5 minutes scheduled for intros. The VIVA benefit plan overview, a lot of 10 minutes for that. And of course, as questions dictate, we'll adjust the agenda and take as much time as we need to walk through this. The benefit plan features and options, we scheduled 10 minutes for that. Plan strengths, 5 minutes. Next steps, 5 minutes. And then an indefinite amount of time for questions. Okay? So, hey, before I hit the advanced button, anybody know what Aviva is? What does it stand for? No? All right. Well, that makes all of us. No, I'm kidding. Aviva, it's a voluntary employer beneficiary association. So, healthcare, looking for options. This first question, is the cost of healthcare for employees becoming a burden? I would assume, and I'm putting words in your mouth, I would assume that answer to you is yes. Because I've met with hundreds of employers over the last couple of years, and for each of those employers, that answer is unequivocally yes. Premiums keep going this way, benefits keep going that way. What do? We know we want to do something. We know we have to do something because it's an effective retention strategy for our employees, but the cost is becoming burdensome. With healthcare reform, one of the things that we have seen, and when I say we, I mean everybody in this room, is that Anthem and United Healthcare have gotten bigger, and Advantage Health Solutions, which was an HMO located here in downtown Indianapolis, they went out of business. So you have a lot of the regional players, if you will, regional insurance companies have gone out of business because with healthcare reform and the small group market and the individual market, the rates are set by the government. Now, when I say set by the government, the insurance company, they say these are what we need to charge, but then the government, and by government I mean the Department of Insurance and the Department of Homeland Security, Department of Health and Human Services, wouldn't that be something? You know, let those underwriters. Department of Homeland Health and Human Services, they're the ones that dictate whether or not that insurance company is able to get that rate increase or not. And so what's happened is particularly as we hear of insurance companies exiting the marketplace, is their losses have become greater and their profits have become less. So it's become something where they've not been able to stay solvent in that market. So one of the things that we've seen as a result of that is, again, with Anthem, United Healthcare becoming bigger, the options becoming smaller, is that organizations, whether they're a school such as yourself or a municipal entity or even a for-profit entity, they are raising contributions to the employees and decreasing the benefit quality, if you will. So what we used to see 7 years ago was that $1,000 deductible was the most popular plan design. So if you look at Anthem, and with Anthem, I believe it was option 26, it was $1,000 deductible, a $20 copay, and it had a $4,000 maximum out of pocket. That was the most popular plan option that they had on the employer side. Now that deductible, the most popular option, it's going to be a high deductible account, which is going to have at least a $3,000 deductible for an individual person. So again, Aviva, a voluntary employee beneficiary association. So this is a form of trust that is permitted under the federal tax code so that employers such as yourselves can band together to offer employee benefits at a more reasonable rate. There are requirements that apply for all of us to join and be a part of the Aviva, and it has to be voluntary. So nobody can hold a gun to your head and say you have to join the Aviva. Okay? So you're going to sign up. You're going to sign up because your own free will. And all of the operations of the Aviva are for providing benefits. Now, this is going to be a little bit different because it says association at the end. And we know that an association cannot exist for the sole purpose of providing health insurance benefits. But this is going to fall a little bit different based on the way it's registered under tax law. Now, the earnings of the Aviva, it can't go to pad anybody's pockets, okay? The earnings have to be applied to paying claims. Now, there are actuarial and financial reserves that are set up in the case of catastrophic losses that any one member would incur so that the plan remains solvent. And it can't discriminate also in the payment of benefits. So it can't say, oh, my name is Klaus Knuth and I'm from Germany, your claims are out. Okay? It can't do that. It has to say, oh, your claim is $10,000 or $200,000 or whatever it is, they have to be paid. So, how do we as an employee get access to the plan? Well, our employer has to grant us access, just like they would grant us access to any other insurance company. So they have to sponsor it. And by sponsoring, that typically means that there is some kind of employer contribution. So the employer pays a portion of the premium for the employees. Now, what the minimum is 5 enrolled lives. One of the things that we see is that, and it's very common, is that employers tell us, I struggle with participation. And because I struggle with participation, there aren't any or a whole lot of insurance companies that want my business because I have 10 people that want insurance out of 35 full-time employees. That doesn't work in the Anthem and United Healthcare world, but it does work in the Aviva world. So the Aviva, as long as you have 5 or more, right, covered employees that will take the plan, you can buy coverage here. So if you have 75 employees and 13 people want coverage, you can't buy that with United Healthcare or Anthem. You can buy that with Aviva. And I can tell you that because we have a client with Aviva, with this program, that has 80, 85 full-time employees, and they have 19 on the plan. And they have the Aviva, and the employees are good to go. There's no static from the Aviva, from the administrators. Life is good. You own your own trust within the Aviva, so by trust, you're paying premiums and you're receiving benefits. Plans run on the calendar year basis. So if your renewal with your current insurance company is July 1st, and you said, I want this Aviva, it sounds good, let's go ahead and go with it. You could sign up for the Aviva. You would have a July 1st effective date, but then on January 1st, you would renew with the Aviva because everything with Aviva is on a calendar year basis. So all groups reset their plan year on the calendar year. So again, last bullet point, it says that you have a short plan year. So with that, there is no deductible credit. Okay. So if you went from Anthem to United Healthcare or vice versa, they would give you a credit on your deductible because you've already met that, and deductibles run on a calendar year basis. The Aviva doesn't do that. So one of the things that we can do with Aviva is they have a zero deductible plan, and a lot of companies that join the Aviva, especially late in the year, like October, November, December, they sign up for that $0 deductible plan, and then at renewal on January 1st, they have open enrollment again, and then they step those benefits up back to where they were prior to that $0 deductible plan. Does that make sense? Any questions so far? So how does it work for you as the employer? You have your premium, right? There are planned election decisions that you can make. You have a setup fee of $100, so the Aviva is run on a self-funded platform, okay? But to you, it works as fully insured. So if your single rate is $279 per employee, you pay $279 for that plan for your employees. And then if they have no dollars in claims or they have 100,000 in claims, you still pay $279 a month. You don't know, I mean, there's no claims reporting per se, and you don't have to worry about advanced funding or any of that stuff. This really is, when we say this is the easy button, we really mean get the easy button out and hit it, because it's going to work very easily for you, okay? And then there's a $20 per month billing fee that applies on an ongoing basis, which again is very common. The $100 setup fee is common in the self-funded market, so anytime you're accessing benefits that are going to be more cost competitive, if you will, it's not uncommon to have a setup fee. So the nitty-gritty, we've covered that it's a self-funded plan. The premium equivalent, so when I say $279 for that deductible plan, that is the maximum cost equivalent. So the underwriter and the actuary, they get together and they say, what do we need to charge on an employee basis for this deductible plan to have a solvent benefit plan, right? Because we want to make sure that going forward that the plan is going to be around and that it's going to be attractive to new employers as well as the employers that we have in the pool already. So the cost that you're paying is the maximum cost. But on a self-funded plan, there is minimum cost, which is your cost of insurance, and there's expected cost, which is what the underwriter expects you to pay in claims plus the minimum cost, and then there's maximum cost, which is if everybody has bone replacement surgery, what does it cost? So that's how these claims, or these costs, I should say, are calculated. It's based on maximum cost, so that there is not ever any situation where the Aviva is running or the plan is running in a deficit. Again, as I mentioned earlier, it's going to maintain, it being the Aviva, it's going to maintain reserves. So if a case arises where someone has a $1 million claim, there is money set aside to pay that $1 million claim. And they're not going to have to come back to you and say, we need more money, okay? None of us want that, right? We truly want this to work as it should. So a specific only stop loss applies to pull out large claims, helping to keep future costs manageable. So in that case where they have a $1 million claim, that's where they have the reserves set aside, and that's where they have those other insurance limits to help protect that. So in that $1 million claim, they might have a $100,000 deductible that they as the Aviva pay, but then they have reinsurance or stop loss that pays the $900,000. And that helps to keep your premiums level as well. And then it's all written under a Bermuda captive, and I'm covering these details with you because I'm a full disclosure kind of guy. And at Keystone, one of our sayings, and it's actually David Bodker is the president and CEO of Keystone Insurance Group, and he's been saying ever since I know him that Keystone is an open kimono company, which is kind of creepy in one regard. But it's good because there's no secrets, right? We're not going to sweep anything under the rug and say, don't worry about that. I mean, if it's something that you need to know, we're going to tell you. Because at the end of the day, this is a long-term relationship for all of us, and we want it to be started on a trust platform, okay? So the Aviva establishes the rates and working with an actuarial firm. Network, Aviva provides a network of services and the safety and number of lives. So there are 2 networks, and we'll cover that in a couple of minutes. You can contribute to the cost of the plan. Anthem, United Healthcare. You know what they require you to pay for the employees, single employees? Half, right? They want you to pay at least half for single coverage. And the more you pay, the better, right? Now, from an insurance company, why do they want you to pay at least half or 100% if possible? Because it drives up participation. the more you pay as the employer in premium for me as an employee, or for Chad, or any of us, the more likely it is that we're going to take insurance. And what that does is, as we take insurance, particularly if we're healthy, you don't have to raise your hands, but how many of you have the younger person between 26 and 30, or even 35, that doesn't want insurance because they're really healthy and they don't think they'll need it? We all have them, right? I used to be that guy. And then I got married and thought, I need insurance. So the more we pay, the more likely we are to get that 26 to 30, 35-year-old person to take insurance. And those are the people that don't generate claims. And from the insurance company, the actuary and underwriter, they think, hey, if you're going to pay 100% that premium, that person's probably going to take the coverage. And that's great for us because that's going to offset claims for Chad when he goes and has a $10,000 claim. So anybody that has claims is offset by the healthy people that don't have claims, and that's why they want you to pay some portion of the premium. Now with Aviva, you can contribute, and the same principle applies, is that the more you pay, the better your participation. But this is a situation that if you're not wanting to contribute a whole lot, you don't have to. They're not going to just come and say, I'm not going to give you an insurance contract because you didn't pay half or all the premium, or somewhere in between that. Does that make sense? All right. So as the sponsor, one of your responsibilities is to offer the plan to your employees. And when I say offer the plan to your employees, what you offer to one, you have to offer it to all. So you can't just offer it to me and not to Chad. You have to offer it to Chad as well. Okay? And I should probably stop picking on him because I have to ride home with him.
You know Rob's name too, so you can.
So, and then as an employer, you agree to pay the invoice. Okay, so every month when that invoice comes and our names are on it, Rob's going to pay the invoice. And again, how it's funded is up to you. So you can fund it half, all, somewhere between, somewhere less than half. It's flexible. Okay. But one of the things that I'll say to you, or that Chad would say to you, and even Rob, is as we're sitting down and we're talking about the plan, and we're talking about setting the plan up, what is the main purpose behind offering the plan? Well, it's to attract employees. We know that you as a charter school, your main competitor is the public schools, right? So the public schools, they have a lot of money. I'm assuming they have a lot more money than we do as charter schools, right? Just based on size and based on tax dollars coming in and what have you. So they're trying to poach your teachers because they know that your teachers are probably better than some of their teachers, right? And so they're trying to poach them, and one of the ways that you can keep that from happening is by offering good benefits. So the more you pay, the better it is, the more attractive it is to your teachers and to your staff. So that's kind of the conversation at that time. That is the conversation that we would have, is what is the main principle to you in offering benefits, and how do we help you achieve that goal? Then you sign off on administrative and network service agreements that enable the benefits to be given to your employees at the illustrated costs. And besides the premium and the setup fee and the monthly bill, there's no additional costs. So all the fees that we would receive, like commissions, if you will, it's based on a per employee per month basis. There's no additional invoice from Chad or me or from Rob. Okay. And you're going to agree to forward any notices from the administrator to your employees and their dependents. And part of this too, the employer agrees to forward any notices. So we're going to provide you with all the forms that you need to be compliant with healthcare reform. And there are a bunch of them that you have to give your employees. So when I say, and I'm just being very technical here now though, is when I say provide notices to your employees, those are some of them, but you're going to get those from us. So you're going to have some notices from the administrator of Aviva, and you have some from Keystone and Miller. Any questions? All right. You have anything to add?
No.
And I think plus it's important to kind of show where we started from. I think, in our earlier conversations, we were looking at insurance options as well. We kind of started from, do we establish our trust versus, our own, NQE or, our own
employees to be able to establish the NQE health insurance trust. And then out of those 500 employees, as you recall, there was a feasibility study that was talked about to determine whether or not it made sense from an underwriting and actuarial basis to proceed in offering the plan. And by that, what they mean is the underwriter wanted to take a look at all of you and all of your employees and the other charter schools that were interested and say, what's the risk? And can we make money on the risk? That's really, to be honest, that's what it boils down to, okay? So we have been talking, and so we have this VIVA, and I've rolled this out to other associations as well. So we have this, I forget the name, it's been a while. It's the National Association of Driving Schools, okay? So we rolled this out to them, and their members. And so they're offering this to their members as a benefit. So it's a VIVA, and a Voluntary Employer Beneficiary Association, but this is the NQE VIVA, if you will. This is the NQE Association plan. But it's easy button because it's an already established plan. So there's no feasibility study that needs to take place. You decide that you want to join, you decide you want to join, and you decide, nah, I don't want it. That's fine. Okay? Because the plan's already established. We have 15,000 employees that participate in this plan, with some with families, some not, some are just single. And so, and I'm not picking on you or you or you. I've got to meet together. So it's already established. There's 15,000 people in it, and that's why there's no feasibility study, because it's you apply, and we'll cover some of this in a couple minutes. But that's why we call it the easy button, because we don't have to do a whole lot of exercise to get this thing off the ground. It's already off the ground, and all we have to do is decide, do we want to join or do we not want to join? Okay? Does that make sense? The answer?
Yeah. I wanted to kind of go over that path that we've come from, and kind of, why we lean towards one option over the other. So
sure.
Based on feedback we've gotten from, our schools. So.
And you don't have to pay us anything to join this. I mean, you just pay the premium. Join, okay? You can pay NQE, take them out to lunch or something.
All right. We'll take that.
All right, so what are the features? What are the plan options? So again, participation in the plan is voluntary. Like I said earlier, nobody's holding a gun to your head or a slingshot or anything like that. It's up to you. Employees can choose from up to 9 plans. Now, I'm going to stop right there. There's 9 plans. If you had 9 employees in your school, you could technically say you, all the way down, you can each have your own plan. And they could all have one plan, and you'd have 9 benefit plans. And I don't know how many employees you each have, but if you had to administer 9 employees, you would probably have a head looks like mine. Okay? So what I would suggest is, as we go through this and we say, hey, I like this plan, I like this plan. Let's pick 2 or 3 plans at the max, and let's offer those to employees. Because what you don't want to do is have 9 plans, okay? That the employees say, I want all these plans, because that becomes an administrative nightmare. But if we can have 2 or 3 plans that we offer to employees, now we have some really good benefit options that we can provide to employees, and we all like options. So one of the things that we've found, and I've been doing this a long time, is that the more options you provide to employees within reason, the happier they are, okay? So the plans range from, I mentioned earlier, a 0 deductible plan. By a low deductible, it's no deductible, okay? All the way up to a $63.50 deductible plan with copays that is a bronze metal level or bronze metallic level plan. So with healthcare reform, we have the bronze, the silver, the gold, and the platinum metallic levels that are at 60, 70, 80, and 90% of actuarial value. So all these plans meet at least that. The highest deductible plan, the $63.50, is at that lowest level plan. It's designed to cover 60% of actuarial value in claims for any participant on that plan. And then the 0 deductible, that's going to be more in that platinum range, okay? Spouses and children can be covered. Well, hot topic with a lot of different employer groups is a spousal carve-out or working spouse provision. And the reasons behind that is that a lot of spouses work at other employers, and the employer mentality is, if my employee spouse is working at One America right across the street, why do I want to pay his or her claims when One America should be paying his or her claims? So that's become the genesis of the spousal carve-out. It was about 6 years ago, UPS came out in the news for not offering coverage to spouses anymore. Well, that's not what they were doing. They were just implementing the working spouse provision, and to date, they were the largest employer to do that. So it made national headlines. But it's become very common. So that's something that you can do. You don't have to do, but just for what it is. But what I will tell you is that you have to offer coverage to the children. So I have 3 kids, and if I work for you, you don't have to cover my wife. But if I want to cover my kids, you can't prohibit me from covering my kids. But what you can do is you can say, Klaus, we're going to cover X% of your premium, and when you cover your kids, you're paying the difference. So you're paying the whole child rate, okay? And maybe you don't say it exactly like that, but that's how it ends up shaking out. All right, so what are the options for plans? Plan number 1, 0 deductible. And then you see a 500 and 1,000, 15, 2, 3, 5, and then 6350, that value plan. And again, option 8, that is going to be that bronze metallic level plan. So if you want to look at a very high deductible plan and with a lower premium, that's the way to go. The $0 deductible, that's going to be the highest premium with the lowest deductible out of pocket. And then we have an HSA plan as well, $3,500 deductible health savings account plan. Any of you have HSAs now? Good. All right, so every plan includes medical and prescription drug coverage, in and out of network. Now we have 2 networks, okay, and we only have Cigna on here because most of the companies in the Viva are going to qualify for Cigna, and to qualify for Cigna, you have to have 25 employees on your plan. And if it's not 25 employees, it's going to be a network called First Health, okay? Then there's the provider directories as well. They're both very robust networks. Cigna is a large network, and they rent their network out to a lot of different entities, so it's a very national network, and the coverage is going to be very good with Cigna. And so now ID cards, how do employees and how do members access their benefits? So the Cigna network for medical benefits, the prescription manager, so they have a PBM, it's called Pharmacy Benefit Manager. They're going to manage the pharmacy benefits. And then there is a third-party administrator that pays claims. So you pay the premium, I have a claim, the third-party administrator, they say, okay, you paid your premium, spouse had a claim, what's the schedule of benefits? And then they're going to match all that up, and then they're going to pay the claim. So the only thing you have to do is pay your premium. And then, members present their ID card just like they would today. And then non-medical. So Keystone, when we started out in 2009 as the Keystone Benefits Division, but we were a privately held agency. We were actually one of Chad's Keystone partner agencies. And then Keystone bought our benefits division in 2009. And we rolled out an association plan to Keystone, to our own agency owners. I think you're on that, right? And has all of these are part of the Keystone plan. Now, when we buy or rolled this out, we had a decent amount of business, okay? But then we added, I want to say 3,000 employee lives like that. And since then, we have added thousands and thousands and thousands of employee lives. So one of the things that we have done as Keystone is we have gone to Lincoln Life, MetLife, Guardian, and Principal. And those are our core carriers. On the property casualty side, Keystone utilizes core carriers, and those are the carriers that they funnel, or they being Chad, okay, and Chad's business, Keystone Partners, funnel most of the property casualty and workers' comp business too. And we get a lot of fringe benefits. Our clients get a lot of fringe benefits because of those relationships. On the non-medical side, core carriers, that makes a lot of sense. So we went to all these companies, these 4, and we said, we want to make you a core carrier. But in order to make you a core carrier, we need some stuff. And by we need stuff for our clients. So we have a plan that if you have dental and vision, we can match your benefits, okay? But if you have life insurance, you have disability, short, long, and then you have any kind of voluntary coverages, we can save you no less than 10% on your current premiums, not your renewal premiums, but what you're paying now. And then depending on what lines of coverage you add to that, we can save you as much as 20% in premium off what you're paying now. So when we say easy button, like as we did earlier, this is the easy button. Now, we're not talking hundreds of thousands of dollars like we are on medical, but in some cases we are talking $10,000, $15,000, $20,000, $30,000 in these life insurance and disability programs. So if we can save you 10 or 20% on those, and it saves your employees 10 or 20%, now we're starting to at least save you some money. And we do a contract analysis as well that says, does this plan work for each of the covered members? So you might have a principal that is making significantly more than the teacher, and the disability contract is set up at teacher salary requirements, but it's not going to cover the principal at his or her level of pay. So we look at those contracts and we say, okay, this isn't going to cover the principal, so we need to adjust the contract. Because of the relationships that we have, we can do that, and we do this all the time. For all of our clients, is we look at the contracts, we perform an analysis, and then we point out where there might be a hole, or as I call it, a gotcha moment in that contract, and we fix it for you, and we roll that out. Anything to add?
No, that's great. I think your point's really well taken there.
Any questions so far?
Can you maybe, I think everybody raised their hand that they're on an HSA. Can you just explain the difference a little bit between a PPO, HSA, why most companies or employers are going to an HSA now?
Yeah, so we have in PPO plans, and PPO is really, and I'm getting way down the weeds now, sorry.
I said high level, actually.
PPO is the organization of doctors that you have access to, preferred provider organization. And so PPO, everybody refers to it as a copay plan, right? But really your HSA is on PPO as well. The difference is that you have a copay for first dollar benefits, and that copay is $20 or $25, maybe $30. So I need to go to the doctor, I'm gonna pay $25. It costs $100 for a doctor's office visit. So the insurance company says, I'm paying $75 for Klaus to go to the doctor. Okay, so I need to charge Klaus more for that plan. And so what happens is they build up the premium you pay to have that first dollar benefit. If you get a prescription drug, and it's a $60 copay, a non-formulary, right? That drug is probably going to cost about $300, depending on what it is, and it could even cost significantly more than that. Some of the newest drugs, Phil Mickelson, he's sponsored by, is it? It's like Januvia or something. It's for psoriasis and arthritis. Okay, those drugs cost $5,000 a month, and your copay might be $60. So the insurance company, they build up the premiums on those copay plans to account for the losses that they incur when you use your benefits. So then you have your deductible, and then you have 80/20 typically. That takes you to your out-of-pocket matching. So an HSA is that there was a deductible, and this is the case with the VIVA, it's a $3,500 deductible, and that $3,500 is our responsibility as the plan members to meet before the plan pays anything. Now, while we're meeting that deductible, we can set up a tax-free savings account with which we can, I should be called a tax-free checking account or debit account that we can use to pay for our medical claims.
Can employers contribute to the HSA in addition to having their employees?
Yeah, so we can contribute as the employee, but also you as the employer can contribute to the HSA. And what you do for one employee, you have to do for all employees. So if you're going to, and typically it's a split. So if you're going to pay $50 a month for singles and $75 or $100 for a family, you have to do that for everybody that falls in those categories. Perfect. All right, so what are the plan strengths of the VIVA? Again, like we talked about earlier, this is the easy button plan, okay? So it's already established. There are 15,000 employee lives, which makes this plan robust, predictable, and sustainable. And what does all that mean? Well, that means that the rates for the past several years have been in the single-digit increases, right? How many of us have had a double-digit increase in the last several years in health insurance? Yeah, so most plans, national trend is 12%. Okay, so that means that before the underwriter even looks at your claims, your renewal is going up 12%. And then they look at claims, and if it's been a not so good year, then your renewal could be 20, 30% or more. Okay. So the VIVA, because we have 15,000 people in it, 6% in 2015, 6% in 2016, and that was 8% in 2017. So for 3 years, it's been a single-digit increase, which that's, from what I'm seeing, we're working with hundreds of companies, that is really, really solid. Okay. Again, 9 different plan options. Yes, sir.
Health savings account. In order to have it tax-free, you have to be on a high deductible.
Correct.
So if you choose the $2,000 deductible, you can't have a tax-free health savings account.
You can't have a health savings account, but we could set you up with a flexible spending account, which the employee can defer pre-tax dollars into that, and then use that to pay for their medical claims.
Now, the flex account, use it or lose it.
Correct. And the health savings account is a use it or don't. So those monies in the HSA roll over from year to year to year. But like you said, with the flex, if you allocate $2,000, and on December 15th you still have $1,500, you're buying a lot of Band-Aids. Yeah, they're putting money in.
Yeah, to just be more costly. I had that when I was working for GI, and it was beneficial to be a great deal. You pretty much plan to know you're going to be
Right. Yeah. Now, the difference between the HSA and the FSA is that with the health savings account, the account is built up over time. But with the flexible spending account, if you put or you allocate $2,000, you're going to fund that $2,000 as you go through the year, through payroll. But the account is built up to have $2,000 in it from day one. So if you only have $50 in there, but you're spending $1,000, the $950 is coming from the employer, and it's reimbursed to the employer by the employee over the course of the year. Okay. So just
Kind of an upfront cost of the employee, basically.
correct.
It's not, hey, you have to put $2,000 in the fund this, it's like, makes sense.
Yeah. So good question. Thank you. So you can partially or you can fully fund the cost. Again, it's you have some options there. I see plan flexibility again. ACA, the plans meet ACA requirements. Preferred pricing for non-medical options. So again, Keystone and Miller Insurance Group, we are one of the largest writing agencies with these non-medical carriers. And quick story. So we have a municipal client. About 120 people on their health plan, and we wrote them with Lincoln, which is one of our core carriers. And so part of what the evolution of our benefits division has been that our non-medical business is written in a trust. So we're going to write you kind of like the VIVA, right? The VIVA, if you buy that, you're buying with 15,000 other employees. Our non-medical, buy non-medical from us, you're buying with thousands of other employers. So this client, municipal client, they 120 employees on the plan, their dental plan, their loss ratio is 110%. So that means that if they paid in $1,000 in premium in dental over the year, they spent $1,100. Okay, so not really. Hey, all right, I'm glad you had you insured. Okay, from the underwriting standpoint. Okay, they lost money. So they got an 18% increase on dental. And I called my rep, his name is Dean. Hey, Dean, Klaus, and I want to talk to you about city of their dental plan. He says, okay. I said, they got an 18% increase. He says, yep, and let me stop you right there. He says, you're with Keystone, and that means that all of your business is written in the trust. I can tell you right now that if they were not written in the trust with Keystone, their increase would have been 35% on dental. And I said, that's great. Thanks for the information. I need a 5% increase. He's like, I don't know if I can do that. I'm like, well, I need you to try. He says, all right, I'll try. So we hang up, and 2 days later, he sends me a nice little email, and he says, I got it done. So we went back to our client, and they were pretty happy about that. Okay. So when we say preferred pricing, and that this gives us leverage, that's probably the best example I can give you. Okay. Enrollment options. So I'll just going to breeze through this because we're going to cover it in a couple slides here. Okay. Next steps. So what we'd like to do in terms of next steps is compare what you have. So who are you with? Anthem, United Healthcare, you with PHP, SIHO, whomever you're with. And then, so let's get those plan documents, and then we'll bring all of the 9 plan designs and all the pricing for the 9 plan designs to your school or wherever you want to meet, and we'll evaluate them. We can talk through them, strengths, weaknesses of this, weaknesses of that, and give you a very good objective opinion. Okay, and then from there, we'll say, okay, does it make sense to give us a census? Does it make sense to go through Easy Apps? So what's Easy Apps? It's an online enrollment system. And by online enrollment, what I mean is we as employees, we would go on to Easy Apps. Once we get the census, we'll get you set up. We'll send you username for all of your employees. You'll send it out to all of your employees, and then they'll log on to Easy Apps online. They'll complete the medical questionnaire on the internet. It's all HIPAA secure. Okay. Once they finish that, we'll shop it, we'll send it out. We'll get the rates back. The reason that we use Easy Apps is that we can not only shop the Viva, but we can shop every other health plan out there for you and get you guaranteed rates from the Viva and get you guaranteed rates from other carriers as well. And additionally, the Easy Apps system will store that data. So next year, you get the Viva comes back and it's a 3% rate increase, and you say, I'm not shopping that. And the following year, it's a 15% increase. You say, I'm shopping that. Okay. Now the employee goes in, and they only have to update their information because it stores everything that they put in there today. And then in 2 years, again, they just update. So if nothing's changed with their health history, it might take them a half hour to an hour, depending on what health issues they have. So when I first did this enrollment online, at that time I had a wife and 2 kids. Now I have a wife and 3 kids. It took me 45 minutes to go through there because I had to put in all the stuff for my wife with having 2 babies, and then our babysat and stuff, and so I had to put all that in there. But the following year, we didn't have any changes. It took me 5 minutes. I had to remember what my password was, which I think that took me longer than signing. I just logged back in, I signed my name, boom, done, out. Okay? And then my employer was able to shop the market for all the options. And that's how it would work for you as well. Is that the first year it's going to be what we call the heavy lifting because they're inputting all of their data. And then the second, third, fourth, fifth, you name it, it's just updating. And if there's no updates, then you just sign. Okay?
Question.
Yeah.
So we're in the Viva.
Huh?
And it turns out that if the EDF process is updating us 2 years from now, is a better option.
Huh?
We out of the Viva and in with someone else.
You could be. You could be. So if we're in the Viva and we shop the Viva, it doesn't mean necessarily that the Viva is going to be the highest priced option. It could be that we shop Anthem, United Healthcare, and PHP and the other options at that time, and those options they come back more unfavorably, if you will, than the Viva. Okay, but it could be that they come back and they're better.
Currently, we go through that process every year anyway.
Sure.
So our only advantage would be, well, just keep the Viva. If we get in it and we end up opting out, right back to where we started.
And I only say that because I want you to know that the Viva, it's flexible. It's not, again, as I mentioned earlier, nobody's holding a gun to your head and saying you have to do this. Okay? I want you to know that this is just how we operate, okay? And we want the decision that we make to be based on fact and not just on what we say because we're the insurance people. Okay, we want you to know that when we bring you an option and we say this is the best option for your renewal, for your employees, that it's based on market findings, based on factual data.
The good part about this, have all the information already, unless there was employees that were added, during whatever, after the year that we did the Easy app. The thing is, now, the way it stands now, and this could change next week, if the Senate decides to pass a new bill. The way it stands now is the rates of the rates. So whether you broker your health insurance through United Healthcare or Anthem, through Miller Insurance Group or Arthur Gallagher or whatever you have now, the rate is the rate. Anthem has to get the exact same rate to each of those brokers. So you would just be with us, and we do the heavy lifting for you. That's what, even though you leave the Viva per se, you still wouldn't have to go through a whole new process of doing a new census, doing new Easy apps, and doing some heavy lifting.
Haven't we seen some play on the margin through the insurance companies, especially coming into getting rate at the first time, will put you below the level, see your double digit increase to try to norm that back? And how do we avoid that kind of game into the Viva structure?
Yeah, so the Viva, it's if you look at bullet point, that's a reject. The Viva already has pricing in there for your common conditions, okay? So high blood pressures, even your well-controlled diabetes, okay? Those are all written in. So when you look at the plan rates, you say, wow, it's $279 for that $3,500 deductible HSA. I think that's the right premium. That's already priced for people who have those kinds of conditions, okay? So there's not necessarily that shell game that I'll call that, okay, what you're referencing, right? Because that has been, when I started in the business 14 and a half years ago, we started out with applications, paper apps, and a spreadsheet, and it was the bait and switch. The rates were X, and now they're Y, and why? Why did they change, right? Well, it was bait and switch. The insurance company was buying your business this year, and knowing that you might not have some claims, they wanted to get you in, and now they don't necessarily want you in again, okay? So that's where the Viva does make it easier on all of us, is that we're buying insurance, we're pooled together, we're underwritten together, and they're going to, I can't say this officially, but unofficially, and this is just my thought, is that whenever you buy business, buy insurance, if you will, through large buying groups, if you have 13 employees in your plan and 10 of them have cancer, they're going to price you out, okay? And I know it sounds mean to say that, but at the end of the day, there are people who sit at the top of the Viva, and they analyze claims, they analyze financials, and they say, how can we keep this plan growing? Because and honestly, not that there's any other way to be, okay? But they make money when you buy the Viva, okay? When you don't buy the Viva, they don't make money. And so if they don't police it and say, wow, this company of 13 employees has 10 people with cancer, get them out. They don't do that, they're going to lose money because now the Viva is going to become insolvent. And so it's going to take a lot for 15,000 plus people to become insolvent, okay? So they're pricing, and then they're monitoring that kind of stuff. And I know it sounds mean to say they're going to price you out, but that's the only way to really keep any of this large stuff solvent for all of us going forward. Okay? And I've seen it with there's captives. So if you had 50 or more employees in your plan, or even 100 or more, you could buy a partially self-funded captive program where you're buying in with 35 or 100 other companies that are like-minded. They do the same thing. They're going to give you an 8% increase because that's what they pass along to everybody else. But if you're the group that has 75 employees on it and 15 of them have cancer and then another 8 of them have congestive heart failure, they're going to give you a 5% increase because you're dragging down everybody else. Okay, so that's the company that's giving everybody else the 8% increase, and if they had priced them out the previous year, then everybody else could have gotten their 4% increase. Okay, does that make sense? Yeah.
You can't be kicked out of the Viva. Once you're in, you're in. So if you have an employee that gets cancer during a year that you're in the Viva, you're you're still going to benefit from whatever rate increase they would have originally, right?
Yeah, and that's a good distinction to make. Thank you for that. Thank you, because I didn't want anybody to think that they're going to kick you out. They're not going to kick you out. They can't make you leave, but the premium increase could make it where we're like, oh, Anthem, more competitive. Okay. But you'll always have, once you're in, you're in. There you go. It's no. So let's go back here a couple slides. All right. So there's no HMO option per se, but these are all PPO, meaning that you have preferred provider opportunity organization. Okay. Now, this is going to be the closest that we have to HMO right here in the zero deductible plan. When you say HMO, I'm thinking the traditional HMO, right, where you have a copay for all of your services, and then you have an out-of-pocket, which is in this case, an accumulation of deductibles, accumulation of copays and co-insurance expenses. But in the sense of an HMO, from a network basis, meaning that you have to select a preferred provider, meaning your primary care doctor, and then use them as a referral before you can see a specialist, you can just go to any specialist you want in the network, and you're good to go. That's what between HMO is that with an HMO, you have a gatekeeper, which is your primary care doctor, and you have to go to him or her for any and all specialist referrals. If you don't, it's not covered. With a PPO, you can have a preferred provider, which we prefer, right? And you have a family doctor, but you don't have to call your family doctor and say, hey, doctor, can I go see a specialist because I think I need to see them because I have a lesion. You can just go. Okay? Question?
You said the $279 figure earlier. Can you go back and clarify?
Yeah, so that would be, and don't.
I'll pull it out. Yeah.
So that would be the single rate on the HSA. I think I'm close on that. I'm not even spot on. Chad can double check it.
So in terms of estimates on the other 8 plans, that's something we discussed in person on the site visit.
Correct.
Yeah.
297. So you transposed the last two numbers. Close enough.
Yeah, so 297, that would be the single rate for HSA. Okay. Which that's pretty competitive. And all these plans are going to meet the ACA requirements. So it's not like you would buy the plan through the Viva and now you're not meeting ACA. You're going to be ACA compliant. Okay. And
I get the weekend in a month.
yeah. And so I'm on broker advisory council for Anthem, and it was early March. I was down here in Indy at Anthem's headquarters for a meeting, and Anthem had their chief actuary and one of their lobbyists, attorney. And this lobbyist attorney, he is formerly on the Mitch Daniels administration, formerly on Mike Pence administration, and still is very connected to Vice President Pence. They both said the same thing. They said, we don't know what's going to happen with what I call Trump care, right, and the ACA, but we don't foresee any changes taking place at least until January 1, 2020. So the ACA is the current law of the land, and it's going to continue to be the current law of the land until at least then. So there's going to be so much that has to take place. Interesting thing is my wife ran the Los Angeles Marathon in March, and we came back. We flew out. My kids go to the pool and swim in March, and we just can't do that here. And so my wife and I, we took them down to the pool. They're 12 and 10, and you guys can swim. We're sitting in the hot tub. And so we're sitting in the hot tub with our 3-year-old, and this family comes down, and they're from Utah. Start talking to them, and she says, so what do you do for a living? I said, well, I'm an employee benefits consultant. So what do you do for a living? I work for the IRS. I'm like, oh, this is going to be interesting. And so she asked me my opinions on healthcare reform, and I said to her, I said, well, one of the things that we're doing, even though President Trump signed that executive order saying that taxes and fees wouldn't apply, we're telling our clients that you still have to pay your taxes as an employer, right? And file all the paperwork that you're required to file, even if that order wasn't signed. And she said, you're absolutely right. You still got to do all that stuff. So even though there's laws in place in my office, we actually have a webinar going on right now about AHCA. In the Senate, they're talking about it a lot. And I think what we have, this is what we have. We have the Senate and we have the House. And they each play to different interest groups, right? Different voting blocks, although some of the voting blocks are the same based on geography. They both want different things. And then the president wants something. And then Democrats, because we know in the Senate they need at least 60 votes. I don't think with HCA that you can have just a simple majority. They haven't found nuclear on that yet. So they're going to have to negotiate with Democrats to get all Republicans plus some Democrats on board. So it's going to look a little bit different. It could be even dramatically different than what the bill is that's being presented to the House or passed to the House last week.
I think I want to be cognizant of your time. If you have other questions, we'll certainly answer them right now. The next steps were kind of our last slide. So I don't know if we'll just hang out here. If you want to ask questions individually, you can. You guys shared our contact information already?
And we'll share it again with this webinar.
Perfect.
And also, this was built for you guys to kind of ask questions in real time with your own specific instances and plans. So you can take advantage of these guys, hold them while they're here. I know Klaus has a 3-hour drive back, but
I make it all the time.
but they're here to honestly help out and kind of answer those specific real-time questions. So if you're thinking of making some changes, if you're, kicking the tires on a couple things, this is, kind of the opportunity we wanted to present to you guys. And, if you have questions down the road, we'll send out this webinar to everybody as well so that you have their contact information and you can follow up. So, kind of only working once we kind of starting off this process a while back, and hopefully we feel like it's a good fit. So, great. Thank you.
Awesome. If you want to stop the recording
Yeah.
there.
Awesome. And I'll download so I can.
Great.